This PPT has been prepared by referring many sources from the internet that includes figures, videos, notes, textbooks, and it's exclusively used for the purpose of education. Welcome to part 4 of module 5. This is the last part of this module. In this module we will discuss about various aspects of taxation, what are the different types of taxes that we follow, and modes of taxation that we follow in India. First one is the income tax. What is that income tax? It is levied on both annual income of both individuals as well as the companies. If it is on an individual income tax, if it is on individual, it is called as individual income tax. If it is on a corporate or a company, then it is called as corporate income tax. This increases as income increases and is levied on the net income after deductions allowed for the permissible expenses under the income tax. And this rule keeps on changing from year to year, and as and when we increase the income, the tax slab also increases. From 1939 we follow the adoption of the slab system, and it has changed many times, and currently we are following a particular system that we will explain at a later stage. The tax is collected at source, and it is the duty of the employer to deduct the income tax from the salaries of their employees and deposit with the government. So all these salaried class, for all the salaried class, the income tax will be deducted at source. It is called as TDS, tax deduction at source. So they will deduct as per the income, and it is the duty of the employer to deduct the tax at the source and deposit with the government. At the same time, it is the duty of the employees to declare any other income if they have, in addition to the salary, before the form 16 is generated by the employer. So as a prompt citizen of the country, employees also have a role to play in the nation building, and as a prompt employer of the nation, they also have a role to play in building the nation. So both employees and employers play a very vital role in building the nation. So in India, it is estimated that around 4 crore people pay the income tax. That includes both corporate as well as individual income tax. So apart from these things, there are many other indirect taxes that every consumer pay while they purchase any goods or items. So income tax is is only for those who earn the income. So when I earn the income, I have been given an opportunity to earn the income, and hence I need to pay tax for that. In India, a person is defined under section 2 of 31. Who are they? An individual, a single person who is earning, or a Hindu undivided family, normally termed as HUF. A Hindu undivided family, if the members combinedly they earn some amount, maybe from a private business or as employees, it's also termed as a person. A company, a company which is manufacturing some part and selling it in the market, either the domestic market or the foreign market, that is also considered as a person. A firm, a firm it could be an agricultural firm or it could be a chemical firm, that is also termed as a person. An association of persons or body of individuals, whether incorporated or not, it could be INC or not, but even an association is also termed as a person, and they also come under the ambit of income tax. A local authority, like say even the political parties also come under the income tax act, or even a local body also will come under the income tax. Every artificial judicial person not falling uh, within any of the preceding categories will also come under income tax section. Various terms used in the income tax. Normally we use the term previous year. Previous year in the sense, uh, normally a financial year starts from April 1st and ends on March 31st the next year. There has been a great debate over making it from Jan 1st to December 31st. That is merging the financial year with that of the calendar year. But still, it has not yet been approved. Even today, in India, we follow the financial year as April 1st to March 31st of the subsequent year or the next year. What is this previous year then? Previous to this is previous to current year is called as the previous year. So for example, financial year beginning on April 1st 2019 and ending on March 31st 2020 is the previous year for the assessment year 2021. Assessment year is for the following, it is following the previous year. So income of a previous year is taxed in the immediately following assessment year. If the assessment year is 2021, previous year is 1920. If the previous year is 2021, assessment year it will be 21-22. So if I am paying the tax of the previous year for the next assessment year. That's how it goes. Assessee. Who is an assessee? An assessee is the person from whom the tax will be collected, or the person who pays the tax under the Income Tax Act. Some of the heads of the income used in the income tax are income from salary. What is that income from salary? Income from salary and pension are covered under the head of income from salary. So it could be from salary, or even after retirement if we are coming under the ambit of pension. Even pension is also termed as the salary only. So if the pension exceeds a certain limit as per the slab rate, then we need to pay tax to the government. There again, senior citizens will get some advantages, will enjoy some benefit. Super senior citizens, those who have crossed 80 years, they are termed as super senior citizens. They will enjoy further more benefits when compared to senior citizens who have crossed 60 years. So but if they are earning more than the prescribed limit, they have to pay tax to the government. Income from other sources. Other sources, it could be savings bank account interest, fixed deposits, winning in the KBC. If you have won any lottery, or if you have won any competition, quiz, Kaun Banega Karodpati is one such competition. It's not that it's free of cost. We have to pay tax, and it comes out to be normally 30%, and it will be deducted at source itself. Income from house property. This is the rent if I receive from a house property, that is considered as an income, and I have to declare it in my form 16. Income from capital gains. See, for example, I may own mutual funds, I may own few shares, I may get some dividends from the shares, and if I sell shares, again I will get some income, and they are all termed as income from capital gains. So if I sell a house or a land for some amount, within 6 months I have to convert that into another property. If I do not, then I have to pay the capital gain tax to an extent of 30%. income from business and profession. If we are self-employed instead of being employees, if we are self-employed, then we come under this category. And whether you are owning a small business or a small company or an industry or even a financial institution or an education institution or even agents of the life insurance, doctors, lawyers, tuition teachers, they all come under this particular category of business and profession. They are also, they also need to pay income tax as per the total income that they get. So this is the income tax slab that is that is being followed in India now. See here, you can see 0 to 2.5 lakhs, there is no tax. There are certain categories you can see here. See, um, the existing regime, less than 60, that is normal individual, more than 60 to 80, that is senior citizens, more than 80 years, that is super senior citizens. Irrespective of them, it is nil. Even in the old regime it is nil, and even in the new regime it is nil. You can see that on the rightmost side we have the new regime, on this we have the old regime. So we have a choice to switch over to new regime. Last year the finance minister announced this just before the COVID attack. We have a chance either to move to new regime, or we can continue to stay in the old regime. So what is the difference here? From 2.5 to 3 lakhs, it is 5%. Tax rebate can be availed under the old regime to an extent of 5%. Here also in the new regime also I can get a tax rebate up to 5% is can be obtained. 3 to 5 lakhs. In the old regime I can get this. In the new regime also I can avail that facility. If the income is between 5 to 7.5 lakhs, the old rate is 20%, the new rate is 10%. If the income is between 7.5 to 10 lakhs, in the old rate it is 20%, in the new rate it is 15%. If the income exceeds 10 and up to 12.5 lakhs or even up to 15 lakhs, it is 30% in the old regime, and in new regime again they have divided that 20 and 25. That is the advantage. And 15 lakhs, if it is above 15 lakhs, it is 30% in the old regime. In the new regime also it is 30%. What is the advantage in the new regime? See, suppose let me take up this example, 5 to 7.5 lakhs and 7.5 to 10 lakhs. See, in this old regime, if it is between 5 lakhs to 10 lakhs, you have to pay 20% of the 20% as the tax. Suppose if your taxable income is 5 lakhs 10,000 rupees, then also you have to pay 20%. Whereas in the new regime, it comes out to be just 10%. So earlier 20% of 10,000 means 2,000 you should have paid. In the new regime it is 1,000. So 1,000 rupees advantage that we can enjoy under new regime. So that is the advantage of new regime. But as the income increases, you can see that here there is hardly any difference in the tax that's collected. So this is very advantageous when the income is below 10 lakh. If we move above 10 lakh, there is no much difference. But there are certain hidden agendas in this new regime that we will discuss next. Here this income means it is taxable income. certain standard deductions are available, and deducting all those things, whatever I get, that is termed as the taxable income. So 0 to 2.5, it is not at all there. So if total income is 5 lakhs, then my taxable income is 2.5 lakhs, because up to 2.5 I need not have to pay any tax. So the taxable income is 2.5 lakhs. If the taxable income is 2.5 to 3 lakhs, then 5%. So for that again I can enjoy some certain tax rebates under section 87A. That we will discuss in next slide. In addition to these things, I have to pay health and education cess to an extent of 4%. Earlier it was 3%, now it has been increased to 4%. This is done to give some education to poorest of the poorest sections. Even in engineering education we have SNQ quota exclusively, and in order to fund those categories of people, every income taxpayer have to pay a cess of 4%. And in addition to all these things, they are super earners. Those who are earning above 50 lakhs, above 1 crore, above 2 crores and above 5 crores, in addition to 30% tax, they also need to pay a 10% surcharge. Okay, what is a 10% surcharge? For example, see, if you are earning 60 lakh rupees, 60 lakhs rupees, 30% is the tax. 30% of 6 lakhs means it comes out to be 18 lakhs. Okay, 18 lakhs we have to pay as tax. Apart from that, 10% of the 10% of the income tax, that means 10% of 60 lakhs, that is 6 lakhs additional surcharge also I have to pay, because such people are super earners. So more we earn, more tax we have to pay. That is the norm that we are following in India. So earning is certainly not very really enjoyable. Many a times we feel that we are earning more, but when we look at the tax that we need to pay, we may have to pay more tax than we earn, because we may jump to next category. That is one disadvantage of earning more. But people, it is better that we earn more and pay more, because our nation is dependent on us. So we should take pride in paying the tax. It's not, we should not feel embarrassed, or we should not think of cheating by not paying the income tax. We should feel proud about ourselves that we are paying tax, and we are contributing towards the nation building. Conditions for opting new tax regime. These are all the 12 conditions, and these are some of the common exemptions not allowed under new tax regime. That's what I said. We had so many advantages that I could have claimed in old regime, but they are all gone. Under 80C, I could have saved up to 1,50,000. I will come to that 80C section later. I could have saved up to 1,50,000 in the form of LICs, public provident funds, employee provident funds, those things, but they are all gone. You cannot, if you switch over to new tax regime, 5% lesser tax you have to pay, of course, but whatever you could have claimed as the tax deduction, they are all gone. Even children education allowance is also gone, house rent allowance is gone, professional tax is gone, they are all gone. But which are all are allowed? Conveyance allowance is allowed, and health insurance is allowed, transportation allowance is allowed, pension scheme is allowed. That's a new thing they have introduced. There are certain good things, but certain things which were very prominent, like 80C, that was a very prominent section. Up to 1.5 lakhs I could have saved. Even house rent allowance was another great savings. And another major one was this one under section 24, interest on housing loan. Up to 2 lakhs I could have saved the tax, but even that is also gone in new tax regime. That's why it was not welcomed by many people. People felt, oh wonderful, 5% lesser tax I have to pay. But when they saw the detailed document, we were all shocked, because many prominent deductions like ATC, house rent allowance, children education allowance, professional tax, standard deduction on salary, and interest on housing loan, that was major one. All these things were not allowed. So we felt disappointed a little bit, and that's why many of us felt, okay, let us continue in old regime, because luckily a choice was given whether to continue in old regime or to switch over to new regime. Those who did not have any such savings, they did not have any LIC policies, they have not invested under PPF, they do not have any housing loan. For them, new tax regime was a boon. They could save up to 25,000, they could save per year. What are all these sections under sections 80C, 80CCC, 80CCD? Let us discuss that. 80C is the one section under which you can claim up to 1.5 lakhs, and which are all the things that I can pump in under 80C: Employee Provident Fund (EPF), Public Provident Fund (PPF), LIC premiums that I pay, children education loan that I pay, and some of the interest that I earn. All these things could have been covered under 80C. Okay, if we pay excess tax and invested in these things, I could even take the return, income tax return, and I can get the extra paid back to my account. 80CCD is pension fund like National Pension Scheme, NPS, Atal Pension Yojana, and up to 50,000, above 1,50,000, you can claim the tax rebate. And my sincere suggestion to you, it's a wonderful system, APY. Once you get into 40, because you have to start this APY before you reach 40. So before after 35, you please apply for this APY and pay the prescribed premium, and it's a wonderful pension plan. And by 60 years you can start getting the pension. Not a very heavy pension, you can get the maximum is 5,000 per month, but the amount that you pay in order to get that 5,000, when I compare that, it is very less when compared to any other pension yojanas. My recommendation is, please go for Atal Pension Yojana once you reach 35 years. 80GG, and I could have claimed house rent allowance if I am paying above the house rent allowance given by the employer. If the employer provides me a house rent allowance of say rupees 2,000 per month, and if I am paying a rent of for 4,000 per month, then that 2,000 into 12, 24,000 I can claim as the house rent allowance excess paid, and that comes under tax rebate. 80E education loan, individual education loan as well as children's education loan, I can claim the tax rebate. 80EE interest on the home loan paid up to 2 lakhs, that I could have I could have claimed, but under new tax regime it is gone. 80D medical insurance up to 25,000 on individual and the spouse, children, additional 25,000 on our parents, aged parents. So up to 50,000 I can get the tax rebate. But if you pay any amount to the medical insurance, it's non-returnable. You cannot take it back. It's only that if you in case of emergency, it helps us. But I strongly recommend you need to go for medical insurance, because what happens to us at what point of time, we do not know. Many attempts we have seen people suffering from sudden illness emergency cases. They meet with an accident and they may have to pump in lakhs of rupees, 3 lakhs, 4 lakhs, 5 lakhs, which they cannot pay many a times, for which they will go for the loan. Instead, if you have a medical insurance up to 5 lakhs, it's always recommended. 80 DDB medical expenditure up to 40,000. See, in addition to medical insurance up to 25,000. Okay, and you can also claim up to 40,000 of the medical expenditure. See, for example, you have spent around 2.5 lakhs from the medical insurance, and over that you have paid another 1 lakh rupee towards medical expenditure. From that 1 lakh rupee you can claim 40,000 as the towards the tax rebate. At least medical bill will not get reduced. At least you can claim the tax rebate if you are coming under, say, a slab of 20%, and if you claim up to 40,000, 20% of 40,000, 8,000 rupees tax gets reduced. Paying tax gets reduced means it's a benefit for us. So that can also be thought of. Next, we will come to understand the corporate tax. Till now, we discussed about the income tax, various sections available, and various slab rates, and the percentage of the income that I have to pay under each slab. Those things we discussed till now. Now we will come to the last section of this chapter, corporate tax. What is this corporate tax? Corporate is an entity that has a separate and independent legal entity from the shareholders. So, if shareholders have invested in a company, it becomes a public company, and shareholders will become the investors, and it could be even a public sector undertaking, a government run firm, or it could be a purely private firm, or it could be under a partnership, or it could be sole proprietorship, it could be anything. And whenever I say company, it could be a domestic company or a foreign company. Both of them are liable to pay the tax. Domestic company is taxed on its universal income, while the foreign company is taxed on the income earned within India. Okay, or whatever the income they earn due to its business within India, on that the tax will be levied. Then what is the difference between domestic company and a foreign company? Domestic company, for example, say Infosys. Infosys has registered in India. So it is under the Companies Act of Indian government, and it's a part of the Indian system. Our country, it is country of origin is India, but it has its branches in Europe, China, America, South America, many places, Australia. So what is required? Infosys need to pay tax not just on its units in India. It has unit in Pune, it has unit in Mysore, it has unit in Bangalore. So it is not that they need to pay income earned from only these three units. They have to pay tax on the income earned from their foreign units as well. Why it is done so? Because many a times government may feel that, let me discourage my own company opening branches in some other country. Let my own company open as many branches as possible in my country itself, so that will help the company to generate employment. That company's money will remain in the country only. If it generates employment, what will happen? Those employees will pay the income tax. So income tax will increase, income tax flow will increase to the government. Not only that, that is the direct benefit. Coming to the indirect benefit, when the many employees are earning good salary, they will try to spend it. When they try to spend it, the business will improve. If business improves, businessmen will pay the tax again, corporate income tax. In that way, more money will flow to the government. So that's why governments, in order to discourage the indigenous companies going somewhere else, they say that whether you go there or anywhere, you have to pay the tax. So sometimes owing to local condition, companies move to other countries. Maybe that other countries have given some tax shops. Let's see, for example, Arvind Mills, Raymond's. They all have opened their garment factories in Ethiopia. Ethiopia, in order to boost the employment rate and economy, they have given many shops, many support to the companies which they open in their country. Even in India, when we call for the foreign companies to come and open in India, we will give them some tax benefits. We will put them under no tax umbrella, so that at least for 2 years, 3 years, they need not have to pay any tax. So companies will be motivated to come and start the business in our country. So that's why foreign companies are encouraged and local companies are discouraged from going to other countries. What is meant by income of a company? Income of a company, it could be profits earned from the business, capital gains, income from renting property, and income from other sources such as dividends, interest, etc. See, companies they not only pay dividends to shareholders. It is not that they earn the income only in the form of turnovers and profits. It is not only that they get the capital gains. How they get the capital gains? How they get the dividends? Many companies will invest in some other company's shares, maybe the domestic company or a foreign company. Infosys would have invested on Wipro shares, Tata shares, Google shares, Yahoo shares, Nokia shares, Huawei, a Chinese company. They would have invested in that particular country's share market, and by selling those shares they will get the capital gain, and that is also considered as an income to the company. And those companies may pay dividends to Infosys. That is also considered as an income to the company. So that is all, they are all taxable. Okay, and how much tax do they pay then? This is the tax rate. Domestic company with annual turnover up to 250 crores, corporate tax rate is 25%. Surcharge on net income less than 1 crore is nil. If the net income is more than 1 crore up to 10 crores, it is 7%. If it is more than 10 crores on the net income means that is the income that they get after paying the tax. That is the final amount that is deducted from the gross income. Interest, dividends, and finally they pay the tax. Once the tax is being paid, if the company has still a PAT as more than 1 crore up to 10 crores, they have to pay 7% surcharge. If the PAT, profit after income after tax, that is earnings after tax, EAT, they will have to pay 12% if the net income is greater than 10 crores. So if the domestic company above 250 crores, then the income tax rate increases from 25% to 30%. If the net income is less than 1 crore, no surcharge. If it is between 1 to 10, 7%. If it is more than 10, it is 12%. Same as that of the companies, domestic companies whose turnover is less than 250 crores. Turnover, in the sense, that is the total transaction I make. Don't be under the impression that turnover means it is the profit. No. Turnover is the total business they make. Okay. In the form of spendings in the form of earnings and all those things, that is the turnover. Okay, from that turnover you have to calculate the profit. Okay, whereas for foreign companies the tax itself is 40%, and some of the foreign companies will have to pay even 50% also, depending on the type of business what they are making. And surcharge for them, if it is between 1 and 10 2%, and if it is more than 10 crores, it is 5%. This is the tax rate that the corporates need to pay. So till now we discussed various tax forms, how a tax is levied in India, uh, what is the difference between income tax, personal income tax, and the corporate income tax, what is the slab rates, all those things we have discussed. And there could be a small short note types question on this particular section. Give the taxation principle followed in India, then you may have to explain the slab rates and other things. You will get some you can answer some good marks. Thank you. Till now we have discussed all the four parts of module 5. So watch the videos. If you have any comments for the improvement, you can please suggest us. Thanks once again.